They got to change the overtime rules. That was some shit on Buffalo, huh?
I know. What a game, though.
And I hate Buffalo with a passion. I hope they lose every game next season, but they still got screwed, and I'm willing to admit that. Hey everybody, JC Parets here, and we are back with another episode of Pardon the Price Action. I am joined once again by Steven Strazza. Let's get right into it. Steve, where else can we start than with the recent sell-off? We sliced through some key levels this week. Where are we likely to find support?
Well, last week and the week before, we were looking at the September highs and the large cap major averages, right? So Nasdaq, S&P. We sliced right through those levels. And now it's really the September lows that are coming into focus. You can see that in the S&P, really clearly. And we found
early October.
Yeah. Oh, it's early October?
It's like late September, early October is when that range really got going. Sorry, go.
Right. So the Nasdaq and the S&P reacted at these levels yesterday. So now, this is the line in the sand. Definitely can't be long below there, right?
No, that's exactly right. I mean, when you look at, I think the Nasdaq's the cleanest one where you're looking at these September highs. As soon as we broke that 380 or so, there was really nothing to talk about from the long side. Then we broke 350. Below 350, there's definitely nothing to talk about from the long side. Now, if we're above 350, I think that eases up the pressure, the overall selling pressure in the market. And I think some of those value areas that we'll get into, things like more like energy and financials, after that selling pressure has come to an end, those can do well. But that doesn't change the fact that the Nasdaq and a lot of other names in that position are not necessarily in uptrends, but more now in range-bound markets versus a downtrend, right? More of a range-bound market. So now you're playing that 350, 380. So even if even if we're holding above those September lows, while the selling pressure is eased, it doesn't necessarily mean that we're out of the woods. I think we're out of the woods for the leaders, but that doesn't change the fact that a lot of other stuff is going to be messy.
And with the S&P, even if you reclaim the September highs, it's really, like the 4,700 level that you want to see prices reclaim before you can feel comfortable being long.
Yeah, there's no doubt about it. And then one last thing that I wanted to mention was the industrials. I know we're out of time. The industrials, right around 101.5, continues to hold right at those levels. This is the sector that's most highly correlated with the S&P 500. Has done nothing for 8 months. An upside resolution here could be very telling. A downside resolution is going to tell us a lot because, this is almost like when you think value, industrials are almost like a captain of that trade. They're very, they have their fingertips across that value area. So a breakdown there suggests to me that it's not just the growth, but some of the value areas too. So I think that's going to be a big one. All right, let's go.
It's a very well-tested level too. Okay, damage abroad. So international stocks haven't been under as much pressure as the U.S., to be fair, but there's still been damage. What are you seeing when you look through our international universe?
To me, this is the chart, right? Like this is it.
Yeah.
When you talk about stocks from around the world, like this is such an important chart. Granted, you're not going to get a ton of emerging markets. So when you look at something like Brazil, it's going to look different. But nevertheless, these are some of the most important stock markets in the world. And we've been using those 2018 highs as the pivot level. So if we're not above the 2018 highs in these two indexes, that's a big deal. And let's just go over what they are quickly for those who are unaware. EFA is the EFA, which is developed markets outside of North America. Think a lot of Europe, think a lot of Japan. All Country World Index, ex-US, that's the rest of the world outside of the United States. Just so, again, those 2018 highs, that's the big one. By the way, emerging markets, ex-China, looks exactly like that too.
Yep. And so what happened really last week and yesterday was before just recently, it was only emerging markets, EEM, that was below the 2018 highs. And that was mainly being driven by China. The rest of them, you just talked about EFA, the All Country World Index. Japan is a good example too. We could really go down the line. There's a ton of examples. Emerging markets, ex-China, VGK, that's Europe. They're all pretty much holding, but we lost EFA and, ACWX, the All Country World. So now they're in the same category as EEM. So you're seeing that list grow of international indexes that are now below those 2018 highs.
And it's not just the United States energy exposure that is holding up better than everybody else. You're seeing it around the world. So energy, best performing sector of 2021. Commodities, best performing asset class of 2021. So far this year, we're seeing the same thing out of energy and commodities overall, particularly base metals as well. Copper holding in there. And here you are, Saudi Arabia and Qatar, right? So not as
the relative strength from the energy countries really stands out. Makes sense, right? Because it's the only thing that's working in this tape right now.
No doubt about it. All right, let's rock and roll. We're seeing new highs fall just about everywhere that we look right now. Which failed breakouts have your attention? So we get new highs that are failing. Which failed breakouts have your attention? This is the most classic one, small caps, right?
We all remember the failed breakout in the Russell 2000. Probably like the most watched failed breakout ever. We were all watching this range. Everybody got excited when it resolved higher, and it not only did it fail back into the box, but now it's resolved to the downside. The big ones that you want to watch now are crude oil and the 10-year, right? The US 10-year yield really needs to hold those highs from Q1, Q2. And the same with crude oil. You don't want to see that fail either, because really the only thing that's working. What I will say is if this was going to be a failed breakout, you would expect to see a swifter move and just more downside follow through. Today, we're actually higher, the 10-year, I believe, before we tape this. So the resilience there makes me feel like these are more likely to be false starts, failed breakouts.
Yeah, and it's going to have a lot of implications when you look at financials, right? You look at community banks, you look at the United Kingdom, which has no technology exposure, a lot of areas that have been showing strength, have been showing relative strength. The question is, are these going to be massive failures, or like Strazza said, is it just a false start? And you know what I think? And I've been thinking this since a week and a half ago. I've been pounding the table on this. I think it's all going to come down to US 10-year yield. If you're below 1.7% on 10s, then I think all of those are vulnerable for much more severe corrections. I'm not saying that they're going to do what some of these ARK funds and biotechs have done, but certainly can continue to come under pressure. But I think it starts with bonds. And I hate to be always that guy that, we're having a stock market conversation and I can't help but talk about bonds. But man, I think this is really it. I think this is it. I think if you lose 10s, I think industrials are also going to break down, right? Financials are going to continue to get crushed. Maybe even oil and energy ultimately succumbs to it. And it's just an overwhelming, they're taking them all. If that's the case, I think you've lost 10s and you're getting a bit in bonds. And so far, we haven't seen that at all. That, I think, points to ultimately the selling pressure is going to subside and the relative strength leaders, like coming from the cyclicals, are going to be the leaders. They're going to be the first ones to break out. I think that's what that says.
And we're saying, crude and the 10-year are the most important moves. We don't want to see them fail. You could put financials in that category too, but that's going to resolve in the same direction that the 10-year resolves in, right? Financials are going to go where the US 10-year goes. So, all right. The culprits. You wrote a nice post the other day. Every down cycle has culprits. These are basically the areas that get hit first and usually the hardest. What are those groups in this cycle? And what are they telling us right now?
It's funny because a lot of times when people are always bearish and like, JC, that was the top. Was that the top? And I mean, obviously, like in every uptrend, like they ask me what the top is every single time. So I think to myself, okay, let's say that is the top and we'll play this game. Who's the culprit? What group of stocks, what sector is going to drag it down? And a lot of times in uptrends, I don't have an answer. I'm like, we don't have that loop. We keep getting sector rotation, like all the things you see in bull markets, right? You need to be able to point to a culprit. And in this case, I mean, these peaked in February. We can talk about it forever. Biotechs peaked. That was when the New York Stock Exchange new highs list peaked. The advanced decline line peaked. Chinese internet, the ARK funds, all those Kathy Wood stuff, the IPO index. I think the IPO index is just a poster child for that whole trade. You could throw SPACs in there. You could throw marijuana. Those are little tiny nothing. They don't really move markets, but some of these others really do. And these have been the culprits. So I think these need to stop going down before the overall selling pressure subsides, I think. So we got to watch these.
The culprits during this cycle are really just the most speculative areas of the market, right? And China internationally, we could probably group into that basket. This is KWeb, Chinese internet. These have been some of the worst stocks in the market for a very long time. Revisiting those 2018 lows, logical level, and we find our footing here. You could say the same thing about the Renaissance IPO ETF. It's at its 62% retracement, logical level, but now let's see it. Biotech back below those 2018 highs, not good at all. What a round trip from the biotech index. So these things need to find their footing, like you said, before the broader market does.
Yep, I like biotech's long if we're above the 2018 highs. Otherwise, leave it alone. I also really like the ARC. If we're above 81.5, that puts us back above that key retracement level, puts us back above support and resistance. I like that. Below 81.5, you can't touch it. You can't touch it. Above that for a squeeze, I don't hate it. I think there might be easier trades, but the risk versus reward is certainly set up in your favor if we're above 81.5. Otherwise, leave it alone. That's how I look at that.
Yep.
All right, so it's up to me. Crypto getting hit hard, just like everything else. Particularly last week, do we turn around somewhere around here, or do we keep going lower? What are the levels?
We were talking about it earlier. Right now, for Bitcoin, we were watching 41,000, last week, 2 weeks ago. That level gave a few days ago. Now we're watching 30,000. We're really trading, smack dab in the middle of this range. Really no edge here. And it's a sideways trend too, right? So this is a big sloppy mess. I think you're best served staying away from it. If you look at Ethereum, it's the same thing. And that's those September lows. Again, just like we were talking about for the large cap averages, 41,000 is the September lows. And that's the level in Bitcoin and Ethereum right now.
Yeah, and you can see it when you equally weight. This has been our top 5 crypto index. Yeah. We understand that the top 5 has changed a few times, but just because that changes doesn't mean we're just going to throw away this great indicator. It's been really, really helpful for a long time. So we're going to continue to, keep it right at the top of our list. And you can see we're below the first half highs. Sort of the rule of thumb when it comes to crypto is that if you're not above the first half highs, you can't own it. That's been the rule of thumb for like 6 months now. So, and that has served us well, sort of sticking to that. Cosmos is holding up the best. I picked some up, showing relative strength. If you want to put on a starter position right around now, against 34, 35, I don't have a problem with that. What I really want to do is really be very aggressively long if we're above 45. Check out Phantom and Luna as well, showing some relative strength. But the bottom line is getting back to your Bitcoin. As soon as we broke 41, there's nothing to talk about. I think if we could retest 30 again, the most bullish thing that could ever happen to Bitcoin, you will hear it here first. The most bullish thing that can happen to Bitcoin is that it doesn't touch 30 again.
Right.
If Bitcoin doesn't touch 30 again, I think that's going to catch a lot of people off guard. I mean, I'd certainly be surprised by it. If we put in a higher low here and break back above 41, I'm telling you right now, there is nothing more bullish for Bitcoin and crypto than for that to happen. I'm not saying it is. In fact, I think it's a lower probability outcome, but if that happens, look out.
The same side of that would be if we do break 30, it might not be anything more bearish, but probably going to 20, right?
20 at best.
Yeah.
20 at best. If we lose 30, you're probably going to 20. You're probably going to 14. So I think that's the best case scenario. So those are the implications. So yeah, I don't necessarily think we're going to rip right through 41, but that's kind of the point. If we do, that's a really, really big deal. All right, let's move on. Let's play a little game.
Do or die time. So this is a game that we like to play where we say the first word that comes to mind. Today's word is hammer.
When you talk about hammers, Mr. Strazza, you're talking about major reversals. The Japanese say you're hammering in a bottom. So when I say hammers, I think reversal. I think everybody else does too. So I think what you really need to see when you talk about hammers is follow through, right? You got to see that follow through. Go look at your favorite downtrends of all time. You know what you're going to find? You're going to find a lot of hammers. And then you're going to find them continue to go lower, which there's nothing more bearish than a potential hammer not actually hammering in a bottom. There might not be anything that's worse than that. So you'll see that in a lot of downtrends. But when you do get that follow through, now go back and try to find your favorite bottoms of all time. You're going to find a lot of hammers, and not just in the indexes, but in the individual stocks themselves. You're going to see it all over the place. They look like a giant letter T with a long middle part of the T.
Right. So a hammer is a reversal candle. I think a follow through too. You stole my thunder like you normally do.
Oh.
It's a reversal candle. So you need to be, the tactical trend needs to be lower coming into it.
Your first thought is follow through. My first thought is reversal. So together.
There you go.
Right.
And today we had follow through, right? That's another important thing that you have to look at. It's not just how we open following the hammer from the prior session. It's how we close. This morning, if you show the slide, if you look this morning, we were red trading on the lows of the day. It was really ugly. By the end of the day, we had some nice follow through. So we'll see what tomorrow brings. But I will say, seeing these long lower shadows, these long lower wicks, this is, a characteristic of a bottom. If you look back to COVID, the COVID lows of 2020, a lot of long lower shadows. We got two. See if we can get some more in the coming days.
Yeah, because think about the psychology behind what's going on. The sellers knocked them down in the morning, and the sellers could not maintain control. The buying pressure overwhelmed that selling pressure, which is why it reversed into the close. One of the Charlie Dow tenets from back in the 1800s is that closing prices are the most important. Amateurs open the market, the professionals close it. All of those things are kind of alluding to the same thing. So the fact that the sellers were not able to hang on to control and the buyers stepped in, it's kind of like they were driving down to score a touchdown and they just got to pick six, right? Think of it like that, to put it, in the parlance of the NFL playoffs, right?
You're full of great analogies today, huh?
You like that? That was a pretty good one. You like that one.
You're on fire.
All right. 2-minute drill. The defensive areas of the market continue to show leadership. What are these relative strength trends suggesting for risk appetite?
So when we look at the relative trends for defensive assets in the equity market, it's a much different picture than if we look at the relative trends for defensive assets outside of the stock market. So inside the stock market, I'm talking about things like staples and utilities. Outside the stock market, I'm talking about stocks alternatives like treasuries, the yen, or gold. You are seeing a bid. This first chart shows it in staples on a relative basis, low volatility on a relative basis, all the same trade, utilities on a relative basis. All of those trends are pushing towards new highs. This is also correlated when these relative trends pick up. Typically, the market's under pressure. They're inversely correlated with stocks on an absolute basis. You could see that in the next chart. But if you move outside of the stock market, we're seeing something very different from defensive assets. You look at treasuries, gold, the yen, there's been a real lack of any investor interest there. Normally, that's where investors run when they're seeking safety, to hide out and play defense. We're not seeing it yet. What do you think?
I always wonder in situations like this if the strength that we're seeing in consumer staples or in utilities is more of a function of, listen, we're in a bull market for stocks. At one point or another, I'm just punching up how they finished today. At one point or another, the laggards need to pick up the pace and can outperform for a month or maybe even 2 months. But when you start seeing this much outperformance, you start to wonder. So in the same way that we're like, listen, if the stock market's going to go higher, a lot of these growth areas that are just getting slaughtered, biotech, the ARCs, all IPO index, Chinese internet, all of those, for the market overall to go up, those need to stop going down. These, on a relative basis, need to stop going up. You got to stop seeing the outperformance out of utilities, out of staples, out of the low volatility stocks. You need to see that in the same ways you need to see the others need to stop going down. That's how I look at that, right? You want to disagree with that?
Staples on a relative basis have gotten to an alarming level. This is one for the bears right now, something to monitor. When you look at bonds, treasury, gold, or the yen, you're not seeing much of that, defensive positioning. So
no doubt about it. All right, final word. What are you leaving the folks with, Mr. Strazza?
I don't know why, what got me on this weekend, but I was looking at the components that were taken out of the Dow and comparing them to the components that were added to the Dow. This was announced back in August of 2020, this little shakeup. So what happened was Exxon was removed, Pfizer was removed, and Raytheon was removed. They replaced them with Salesforce.com, Amgen, and Honeywell. If you look at any three of these individual issues relative to any of the three that they were replaced with, they were in nasty relative downtrends. So these stocks that replaced them, Salesforce, look at the first chart. I added some charts to the deck if you go down. So Salesforce relative to Exxon. This was in a relative uptrend in favor of Salesforce for 15, almost 20 years, and it reversed basically right before the announcement. If you look at the other relative trends, so Amgen, Pfizer, or Honeywell, Raytheon, all within a 2-month period of the announcement, these relative trends that have been in place for 10 years reversed. So I just thought that was interesting. Whether it's a trading signal or not, probably not, but definitely sentiment, right? I mean, the investing community got so sour on these names that they got booted from the Dow. That's something you see at the bottom, I guess.
This is the biggest company in the world at one point, not when they got booted out, but at one point or another, Exxon was the biggest company in the world, got booted out of the Dow just in time for when all the investors need more exposure to companies like ExxonMobil. What am I leaving the folks with? We were just talking about the analogy of the market and wine and just cultures. And we were talking about the Germanic approach of very rigid, strict, rules-based, how the German wines, the Rieslings are very crisp, very clean, no faults whatsoever. It makes them great. And then you go down to Italy and it's like, yeah, I don't know anything about any rules, but we'll put a little bit of this, a little bit of that, and it's going to be delicious. And as it turns out, it is. And, in some of these, like in the Barolos and some of the Barbarescos and stuff like that, you're going to get that Brettanomyces, which is sort of the, it's almost like a flaw. I mean, technically it's like a flaw in the wine, but what that adds is that funkiness that for us Barolo lovers and a lot of the Bordeaux have that Brett also, what can be perceived as a fault. Certainly the Germans would perceive it as a fault, and, traditionally it is. But that adds character to the wine, and I actually really love it. And a lot of people also do too. And when it comes to the market, it's also like that. It's like, wow, we got an 89% update today, not 90, right? And then it's like, yeah, but the New York Stock Exchange Composite did this, and I'm like, yeah, well, Brazil's making new highs, so right. So instead of like having like these specific rules-based analysis, I think being open-minded to what's working and what's not, and understanding that every cycle is different. I think there's a little bit of an advantage to that. We're not baking, we're cooking, add a little more salt, right? I think that's really how it is. And listen, it's not for everybody, but that's how I like to approach the market. That's how I like to approach my wines too. By the way, I love German wines too, so I'm not hating, but
right.
Man, give me a Barolo all day.
You got to be a little bit flexible. I think overbought and oversold readings are a great example, right? Sun's at 69.9, it got overbought. Don't overthink it.
Yeah. Who do you like in the for the Super Bowl? Give me the two teams.
I'm bummed that the Bills lost, but I'm really pulling for the Rams. When I was in college, Matt Stafford was by far the best quarterback in the country. We were in college at the same time. He was awesome, but he's on the Lions, just an awful team his whole career. Got to feel bad for the guy because he's really talented, class act. So I would love to see him win a Super Bowl.
KC and the Niners. I think that's what it's going to be. KC and the Niners. I like KC going all the way. I think I'm an offensive coordinator. I'm a technical analyst, but
But Super Bowl champions aside, just how about the weekend in football this weekend? I mean, one of the best.
They got to change the overtime rules. That was some shit on Buffalo, huh?
I know. What a game, though.
And I hate Buffalo with a passion. I hope they lose every game next season, but they still got screwed, and I'm willing to admit that.
Josh Allen can play, man. He can ball.
I know. He's a stud. That's why the Dolphins didn't draft him, because he's just too good. That's what it is. All right, guys. I'm JC Parets. This is Steve Strazza. Leave us a note. Make sure to follow us. He's at S Strazza. I am at All Star Charts. Leave us a note. Say what's up, and we'll answer your questions next week. Adios.
Peace.